Hello, this is Greg Donaldson of Donaldson Capital Management, and I'm the Chief Investment Officer here. And this week we were going to talk about bonds in some detail, but I'm going to delay that for just a little while to speak a little bit about the goings-on in the stock market over the last week and actually over the last month. I wanted to take a little bit of a different approach and help those of our clients and those people who follow us to get a better understanding of how we construct portfolios. And the main reason is that I'll call this maybe a teachable moment. There are certain times when things that we believe are central to our way of investing can be understood better than in other times. And our way of investing is what we call a balanced style. Probably 85% of our clients have both stocks and bonds. And so we have a situation in the world today where there's an uncertainty in Europe. Greece is broke, as we've said before. We don't know what the final outcome will be, but all of the uncertainty is causing lots of problems in the stock market throughout the world. But as we work all the way to the end, what we realize is that Greece is about 2% of the gross domestic product of Europe. Europe is about 25% of the world. So we're talking about a pretty small piece. I realize it can have a snowball effect, but Greece is really unique in how bad a shape they're in. And if you bring this to the United States, this is not going to be mathematically correct, but I want to use it just because Indiana is our home state. It would be like this that the state of Indiana, which by the way is rated AAA, one of the highest ratings in the country, but let's say it wasn't so. Let's say that Indiana defaulted. Now it would be hard to believe for most of us that if the state of Indiana defaulted on its debt, that it would take down the entirety of the United States. In fact, I would say there wouldn't be anybody that would agree to that. Yet, what we're saying is Greece, which is 2% of this large body of people and of economic productivity, that Greece going under could take all of that down, and not only that, but take everything else down around the world. Now I have to tell you, there's a little bit of a stretch there that we do not buy into. And we think that there's an awful lot of scare tactics and an awful lot of gloom and doom out there that may not be justified. But importantly, what I want to talk about today is how do we handle these kinds of markets? And here is just a thumbnail sketch. Number one, 85% of all of our clients own both stocks and bonds. So on a day, as I started this broadcast, the market was down about 175 points on the Dow. On a day like today, our stocks are going to be down. It's raining, so everybody gets wet. Our stocks are going to be down. But our bonds are going to be up because on a day like today, there is a bit of a flight to safety. So people, traders, if you will, they come out of stocks and they go into bonds. So there's a little bit of a muted effect from our bonds in our portfolio that offsets our stocks being down. But there's more. The next muting, if you will, is that we, as you know, don't own anything but dividend-paying stocks. And it just so happens that our cornerstone portfolio, which is our largest one, currently has a dividend yield of 3.5%, which is higher than the yield on a 10-year bond or a 30-year bond. So that's good. I mean, in other words, it's giving us a rate of return no matter what the price of the stock does. But those dividends also rose about 11% in the last 12 months, which tells us maybe we can see continued dividend growth. But the big thing is that there, in the world of investments, there's a term known as beta, and beta is a calculation of the volatility of an individual stock relative to the average volatility of the S&P 500. And the beta, or the relative volatility of our cornerstone portfolio right now, is about 0.79, which means this: if the stock market were down on average, let's say today, 100 points, our portfolio, because of its lower beta, would be down about 79 points. That is then a second buffering. The bonds, first of all, they're not only a buffering, but they move counter to stocks. So we're getting a little bit of lift out of the bonds today. Bond prices going up. We're not going to be down as much today as the stock market because of the higher quality companies and the dividend payers. So those are two buffering type of mechanisms that we build into portfolios. The next thing, which is I think vital, and oftentimes we don't get around to talking about this, is if you look in our portfolios, first of all, you'll probably recognize almost every company in there. So these are household name kind of companies. But the second thing is you'll notice that they're really they sell products that we use every day. We call this essential services. They sell essential services. If I just look at where the majority of our money is, you will find that we have a lot of money invested in utilities. Well, you can't turn on the lights without the power company. Another group that we have a lot in is healthcare. The names there, two big ones are Abbott Labs and Johnson & Johnson. Well, everybody likes to live, so again, those are you're using products in many cases from both of those companies every day. The next area is in the consumer staples, and in that area, one of our big holdings is Procter & Gamble. And let's face it, you have Gillette and Oil of Olay and all of the beauty products, and Tide and Crest toothpaste. The things that, again, you use every day. I don't care what is going on in the world, you're going to use these products every day. Another area is in consumer cyclicals. And then the consumer cyclicals, for instance, one of our big holdings is McDonald's. Well, people go there every day to eat. And the food is inexpensive, and the food is tasty, and McDonald's catches all kinds of heck from all kinds of people, but the truth of the matter is it's very popular with almost the entire world, and therefore it's not something you're going to sacrifice. You can eat cheaper at McDonald's than you can probably at home in many cases. So essential services products really play a big role in our portfolio. So what you have then is a portfolio that is balanced. That on a day like today, the stocks are going down, but they're not going down as much as the market. On a day like today, the bonds are going up in price, not enough to offset what the stocks are doing, but they're going up in price. In addition to that, both the stocks and the bonds pay income. The bonds, as you know, it's called interest. The stocks, as you know, it's called dividends. And so, if you will, there's like two buckets. We have an interest bucket and a dividend bucket, but then there's a third bucket. And the third bucket is what we'll call the capital gains bucket. And that is the bucket that prospers over the long run, that takes advantage of the fact that in the short run, the stock market is a voting machine, and it votes irrationally and emotionally, and it votes on what, popularity. But in the long run, the stock market is a weighing machine, and in the long run, it's going to value companies that are consistent growers and companies that have a solid brand and companies whose dividend is rising every year. So we're not smart enough to know how to hide from these kinds of markets. We just don't know. I've done this for 35 years, and my judgment of when to go hide is about as good as my young son's judgment. Therefore, we have built portfolios that we believe can withstand pretty high seas. In other words, pretty bad weather. They can continue to make forward progress through very difficult times, and we get rewarded because we're not guessing on when to get out and when to get in. We are just making judgments about what companies the world in a way cannot live without. Now let me say that again. We're trying to invest on the stock side in companies that that the first rule is that the world cannot live without them at some level. It's not that they don't have competitors, it's just that we've come to really count on their products. And if you invest in that kind of a portfolio, combined with a portfolio of solid interest-paying bonds, you've got cash flow coming in all the time, and in the long run, the stock side of the portfolio will grow at about the rate of growth of the dividends. And over the long haul, over the last 19 years, that rate of return has been pretty generous with in our cornerstone style of management, and it has enabled us to be long-term investors and to not try to figure out when to go run and hide. Indeed, when the world seems to be everyone trying to run and hide, history shows us it's been a very good time to be going back to these wonderful companies that we invest in and to do some nibbling. So I hope this has been helpful. As I said, in these kinds of markets, our kind of portfolio, we believe, shines. It can endure these kinds of markets. And indeed, as I said just a few minutes ago, this is the kind of a market when essentially they've put stocks on sale. And since we believe that stocks are undervalued, we will be using this time to nibble into some of the stocks that we believe have been oversold. So thanks so much. We'll talk again in another week or so. So long for now.